What if one bank's failure could bring the entire global economy to its knees? In 2008, that nightmare became reality. Lehman Brothers, a 158-year-old financial giant, collapsed almost overnight, triggering the worst financial crisis since the Great Depression. Stocks crashed, millions lost jobs, families lost homes, and the world learned how fragile our financial system really was. But how did a bank that had survived wars, depressions, and decades of economic change crumble so fast? Let's dive into the rise, fall, and legacy of Lehman Brothers, the bank that changed everything. The rise. Can you imagine starting as a small shopkeeper and becoming a global financial powerhouse? That's the story of Lehman Brothers. In 1850, three brothers, Henry, Emmanuel, and Mayer Lehman, opened a small general store in Montgomery, Alabama. They sold cotton, groceries, and everyday supplies to local farmers. But they weren't satisfied with selling goods. They saw opportunity in cotton trading, the lifeblood of the Southern economy. By the late 1800s, the brothers moved to New York City, the center of American finance. They transformed their business from trading cotton into trading money. Lehman Brothers began helping companies raise money by issuing stocks and bonds. They financed railroads, supported emerging corporations like Sears and Macy's, and grew into one of the most powerful investment banks in the world. Why did Lehman succeed for so long? Adaptability, intelligence, and trust. The bank learned to survive economic ups and downs, wars, and market crashes. By the early 2000s, Lehman Brothers was a symbol of Wall Street success, thousands of employees, billions in assets, and a global presence. But beneath the shiny surface, cracks were forming. The bank was about to chase a dream that would prove disastrous. The illusion. What happens when even the smartest people believe in a bubble? In the early 2000s, Lehman Brothers, like many banks, got caught in a housing market frenzy. Housing prices were skyrocketing, and everyone assumed they would keep rising forever. People bought homes they couldn't afford, and banks lent money without checking if borrowers could pay. This created an illusion of wealth, a giant, fragile bubble. Lehman plunged headfirst into this risky game. They invested heavily in subprime mortgages, loans made to people with poor credit who were likely to default. These risky loans were bundled into mortgage-backed securities, MBS, and sold to investors, promising high returns. At first, it seemed like a brilliant strategy. Lehman made billions, and CEO Richard Fuld and other leaders were praised as financial geniuses. But was it too good to be true? Absolutely. Lehman borrowed enormous sums of money, sometimes $30 for every $1 they owned. This leverage was like building a skyscraper on sand. The structure could collapse at any moment. By 2007, the cracks appeared. Housing prices began to fall. Borrowers defaulted on loans. Lehman's risky bets started to unravel, but instead of cutting losses, the bank hid them, hoping the market would recover. It didn't. The illusion of endless wealth was crumbling. Lehman's employees, investors, and the public had no idea that the foundation of this financial giant was cracking beneath their feet. The collapse. What does it feel like when the world's trust disappears overnight? On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in U.S. history. The bank had $619 billion in debt. The collapse was sudden, shocking, and catastrophic. Just days earlier, Lehman had been negotiating with potential buyers, including Barclays and Bank of America, to save itself. But no one stepped in. The U.S. government, which had bailed out other firms like Bear Stearns, chose to let Lehman fail. Why? Officials wanted to send a message to Wall Street. Take responsibility for your risks. But the consequences were enormous. Lehman's collapse pulled a thread that unraveled the global economy. Stock markets crashed worldwide. Banks stopped lending, afraid they would lose money. Businesses couldn't get loans to operate. Millions of people lost jobs. In the US alone, 8.7 million jobs disappeared between 2008 and 2010. Families lost homes, savings, and hope. And the crisis didn't stop in America. Europe, Asia, and other regions felt the shock. Countries went into recession. Governments scrambled to respond. Economies that had seemed stable suddenly became fragile. Lehman's failure showed the dangers of an interconnected financial system. Banks, investors, and everyday people were all linked in ways that many hadn't realized. A failure in one giant institution could ripple across the globe. The human cost. Behind the numbers were real people. Lehman's collapse wasn't just about banks and Wall Street. Millions of ordinary lives were affected. Employees of Lehman lost jobs and pensions. Families lost homes because they could no longer afford mortgages. Retirees saw savings vanish. Businesses failed because banks stopped lending. Students and young workers entered a bleak job market. The psychological impact was also immense. Trust in banks plummeted. People questioned the financial system, government oversight, and the ethics of corporate leaders. The crash showed how a single institution's failure could create widespread panic and despair. The bigger picture. Lehman Brothers' collapse is more than a bank failure. It showed how fragile modern finance is. Ambition and risky choices by leaders can hurt millions. Jobs are lost, homes are gone, and savings vanish when trust in markets disappears. The 2008 crash taught governments and banks to be careful, creating rules like stress tests and stricter oversight. Lehman Brothers is a warning. The decisions of a few people can affect the whole world. Lessons for the future. What can we learn from Lehman Brothers? First, no one is too big to fail. Size and reputation do not protect against poor decisions. Second, greed can blind even the smartest people. Chasing short-term profits without understanding risk is dangerous. Third, transparency matters. Hiding problems might delay a collapse, but it cannot prevent it. For individuals, the lessons are clear. Be cautious with debt. Understand investments. Don't assume markets always rise. Ask questions, demand transparency, and stay informed. For businesses, the lesson is the same. Risk management is critical. Ethical leadership matters. For governments, the lesson is to regulate wisely. In conclusion, Lehman Brothers' story is more than history. It's a warning. Greed, risky bets, and ignoring warnings can destroy not just a company, but millions of lives. The 2008 financial crisis showed how connected our world is. One failure can ripple across the globe, affecting families, businesses, and nations. So, what's the takeaway? Be cautious. Think long-term. Avoid chasing quick profits at the expense of stability. The lessons of Lehman Brothers are clear. Trust must be earned, risk must be managed, and greed must be tempered. Want to protect yourself? Stay informed about finance, investments, and global markets. Read reliable sources, follow updates, and understand the risks before you invest or borrow. Knowledge is power. Don't let history repeat itself. Like what you saw? Hit subscribe, leave a comment, and join the conversation for more mind-opening content. Thanks for being here.